Greetings, greetings, greetings to everyone out there in webinar land. My name is Damon Richardson. I'm here on behalf of Remen Wholesale, and this is our very first discussion of the 203H product and our implementation of it here at Remen Wholesale. I do realize that it is 3 minutes after 3 o'clock. I always like to give everybody just a couple of minutes to get oriented. There always seems to be people that need a little bit of last minute assistance with getting logged into the system. So that's what I've been doing the last few minutes. So let's just give everybody a couple minutes more and we will begin in approximately 60 seconds. Thank you, everyone. All right, everyone. It seems that the number of requests for assistance have virtually dropped off. So I believe that we are ready to get going and talking about what really is an historic program provided by HUD. It is called the 203H. This 203H program I know is surrounded by a lot of mystery right now for it being brand new. What I really want to tell everyone here today is that there's a lot of good news because with the unfortunate recent experiences that we've had, not just this year, but in years past with presidentially declared disaster areas, historic storms, and all kinds of calamity. Unfortunately, we realize that there needs to be a permanent solution to the problem of how to help people rebuild their homes after they are hit with some type of devastating catastrophe. And we've learned from the mistakes that we've made in the previous 5 to 6 years, and we're taking all of that experience and we're channeling it in through the 203H. And I, for one, am very thankful for HUD for having the ability to put out something as flexible as this program on their permanent books so that we will be able to help not only homeowners now that are facing a crisis after being a subject to this type of devastation, but also permanently in the future as this program is designed to really stay on the books. But the big question, the largest one, really is, what is the 203H? That is the number one question that we have. And the 203H essentially is an enhancement program. It is designed to designate borrowers specifically that are the subject of a recently catastrophic event that has been declared a major disaster by the President of the United States. So once an area is declared a presidential disaster area and is listed on the FEMA website, everyone that currently resides within that disaster area at the time of the presidentially declared disaster has the opportunity to be determined as a 203H eligible borrower. All right. The great news is it doesn't exclude renters. If you are residing, even if you are a renter inside of that disaster area, you can be deemed to be an eligible 203H borrower, which is a fantastic, fantastic thing. The big thing that needs to worry about, the big thing that any of you needs to worry about in terms of determining who is an eligible 203H borrower, A, being able to prove residency inside of that area, and then B, being able to show that the property that they lived in sustained qualifying damage. And by qualifying damage, we mean damage sufficient to the point that requires major reconstruction or the elimination of the property entirely to cause a borrower to need to separate themselves from the property for safety. Okay, so unfortunately, if the worst of it was flooding and new carpeting, that doesn't make someone an eligible 203H borrower. All right. The great news about this program is that it offers a ton of flexibility to borrowers that are determined to be 203H eligible. But let's get into the conversation about how the program works so that you can best understand how to determine any particular borrower's eligibility to participate in the program. So here is the way this all essentially works. We just mentioned the borrower has to be able to show residency inside of the area. Right, so after an area has been declared to be a presidentially declared disaster area, the borrower needs to be able to show that they held their place of residence inside of that particular area. This is going to include all renters. Now, there is an eligibility window. After the date of the declaration by the president of an area being affected by a major disaster. So once it is a major disaster area, case numbers for borrowers residing in that area within a 1-year window of the date of the president's declaration will be eligible. All right, so there is definitely a time frame within that. And please do remember, even the case numbers that you pull, they all have an expiration date. Case numbers are only good for approximately 6 months. So make sure that your borrowers are A, having their case numbers for 203H eligible loans pulled within that 1-year period. And then B, please do not let those case numbers expire as you are trying to work out the loan for the borrower. Now, the 203H is designed to really give the power back to the borrower. And this is what makes this program so absolutely powerful. It gives borrowers an opportunity to have their own voice be heard in determining how they best would like to begin to recover from the catastrophe. The borrower opts to separate themselves from the area and just needs a clean start in a new place. They will not be required to make a purchase of a home still within that presidentially declared disaster area. They will be free, as long as they are a 203H eligible borrower, to decide to purchase a new home in another area where they feel safe and secure. These borrowers will also have an expanded LTV. They will be able to borrow up to 100% of the actual purchase price and do 100% financing when they are relocating to a new area. Also, these borrowers, obviously, if they were homeowners, they have an existing obligation to a home that's still in that recovery area. As long as they are working out an actual course of remediation with their servicer on that property, they will be able to move on. They only have to show evidence that they are in the process of final remediation, but it doesn't have to actually be done. The great news is this also allows us a limited capacity to expand the one mortgage rule for a HUD. If the borrower is relocating and is working out vacating, their lien on the existing property, we will be able to start the process and underwrite and close this loan prior to that final resolution being done. Also, with the ability to exclude entirely the debt ratio on their existing home located within the disaster area. All right. The ability to go around the single mortgage rule also has a couple of additional uses, or actually abilities or ways that it can be used, including the borrower being able, well, let's say if that borrower was a non-occupant co-borrower on another FHA mortgage, or if it was a joint home and now this is one individual borrower qualifying on their own for a new home, they would also be able to move on with the 203H as a 203H borrower without having to worry about being impacted by the original mortgage lien. Another thing that is absolutely and positively great about this program is the ability to take mortgage rates that are directly stemming from the devastation and not consider them against the borrower's record in the credit decision on the new home. So if the devastation has upended the borrower's lives and they had a brief period of really being upside down as they're trying to figure out how the pieces all come back together, don't let any of them feel dissuaded or really feel that they cannot qualify for a new home because their credit is now a little bit less than perfect due to blemishes because of the disaster. We will be able to completely erase the slate of those particular things. Well, not erase them, but at least ignore them and look back at the borrower's history prior to the disaster when we are making the decision on credit. Now, if borrowers choose to stay put, for those that are steadfast on the on the decision that they must rebuild where they were and get back to normal life as they wanted to live it, the 203H also allows borrowers to refinance their existing lien so that they can take the power back and start the process of rebuilding their homes as they were or better. And that is a fantastic thing about the 203H. One of the most incredible things, starting off with credit, we're going to say that everything credit-wise that applied about purchases also applies to refinances. We will not leave these borrowers in the lurch talking about current mortgage rates if they are due to the disaster. All right, so they are also going to be free from letting the last couple of months post-disaster determine their creditworthiness over their brand new mortgage lien. Also, all seasoning issues that normally would be applicable to any FHA refinances will be listed for 203H eligible borrowers. All right, so this is also huge. The thing that I must say though, the existing refinance limitation of 97.75% LTV will be continued inside of the 203H refinances. Borrowers will not, and I'm going to repeat this, borrowers will not be able to do refinances at 100% LTV. All right, the 97.75% will be factored against the property's value post renovation. So I don't want anyone to think that flood damage or devastation to the marketplace is going to make the key determining role in figuring out what the property's value will be. We will certainly work with our AMCs and everyone else to make sure that we can establish a pre-disaster baseline for value, but then also looking at the improved value of the home and the things that we're bringing into it to make that lending decision on the property's value, factoring in all of that good, useful, and new information. Now let's talk about the qualification process of a borrower to become a 203H eligible borrower. All right, and qualifications are essentially easy. These programs do not really differentiate themselves from the standard 203 platform for FHA, right, which is already very adaptable and very flexible. But it has all of these enhancements that allow it to be even more powerful, even more flexible for borrowers that have been affected by disasters. The biggest thing that is in addition to this, essentially, is knowing how to qualify and determine if a borrower is an eligible 203H borrower in particular. All right, so having that being said, this is not a new standard program. The 203H essentially is an add-on enhancement on top of the normal 203B or 203K for refinances, depending upon whether the borrower chooses to purchase a new home or whether they want to rebuild the home that they had prior to the storm. All right. So with that being said, if you are determined to be a 203H borrower, your credit will be assessed more delicately. We will automatically, by default, not consider against the borrower any mortgage rates that have accumulated as a result of the storm directly. Okay, this is also going to be, to a degree, carried out as liberally as possible as we can with other consumer rates. So we're going to look at the borrower's credit and try to be as flexible and as lenient as possible in terms of looking at the borrower's credit and determining which rates are directly attributed to the actual devastation that the borrower is facing. All right, we do not want to force borrowers to prove their eligibility to have to trudge up too much of the recent bad memories in order to qualify. All right, so borrowers that are able to show a valid driver's license showing an address as their residence inside of a presidentially declared major disaster area will automatically be, considered part of the running. All right, so they don't have to, dig, very deep. In fact, we will take a valid driver's license as the first part of this, a voter registration card, or also a utility bill. So any of those things will be able to use for a borrower to prove that they've resided inside of the area. All right. The second part of the eligibility criteria is really going to come down to showing the documentation of the distress or destruction of of their current home inside of inside of the disaster area in and of itself. And again, we want to reuse any documents that the borrower has naturally incurred as part of this process. So we will take insurance reports, we will take inspection reports, and those are inspection reports that have been done by an independent inspector, or if a government agency has come out to take a look at the property for the borrower, we will accept those as well. If the borrower was in the mortgage process and has had an appraisal report done that is evidence of the damage, we will take that as well. And also, if the borrower was instructed to take extensive pictures of the extent of the damage to their homes, we certainly will be able to accept conclusive photographic evidence outlining the actual devastation that has occurred to their property. All right. Considering that the 203H, though, is not a program in and of itself, that it is an enhancement, I cannot repeat this to you enough. The 203H is not going to have special pricing of its own. All right. The pricing that you will note for your 203H loans is going to be our standard 203B rates if it's a purchase loan, or our standard 203K rates if it's a refinance. All right. So there won't be separate pricing available for this as a program. Don't look for a 203H section on the rate sheet. If it's a purchase, I will reiterate, you will use our 203B rates, so our standard FHA rates. If it's a purchase, if it's a refinance, it's going to be a K. You're going to use the 203K rates when you are pricing one of these loans. Now, considering that I've just basically said that this thing boils down to or equates to being a standard 203B or 203K loan, many of you are probably thinking, well, what is so special or great about the 203H if it's essentially just a regular FHA, or if it's essentially just a 203K? And the answer to that question is very, very complex. The reason why it's complex is because this program really is dependent upon trying to give homeowners or renters that were affected by disasters and separated from their homes the ability to regain control, make decisions for themselves, and begin to move forward again with their lives. So the basic options of being either able to choose to relocate or being able to rebuild your home, and to say with confidence that you will have the ability to pull off either, is at least a step in a positive direction. And then on top of that, the enhancements of the program really are set to make whatever decision the borrower makes that much more attainable and that much more sure that they will be able to pull it off. So if a borrower has elected to move to a new area, if that's something that's been on their minds even prior to the disaster, having the confidence to know that their current credit condition or any lates that are resulting from the actual storm itself are not going to be a barrier for them qualifying for a new mortgage is absolutely fantastic. Also, the freedom to not need to completely and totally resolve everything that's happening with their current residence is also fantastic. Because let's face it, for anybody in that relocation market, this could create many booms in real estate in the markets that they're looking to move into. So not being required to wait in order to move forward can be huge, and determining the difference between coming out with the ideal property that they wanted or a not so ideal property in terms of where they would like to see themselves in their future after choosing to relocate. Obviously, in the relocation effort, being able to go up to 100% LTV if they so choose or if they need is obviously a benefit. All right, all of our normal rules and guidelines regarding gifts and gifts and seller's concessions, all of those things naturally apply, as this is still a standard 203B purchase in our eyes, just with a special designated borrower. So the flexibility of literally the FHA program lends itself to the 203H, as well as some additional flexibility in terms of not needing to have borrowers specifically worry about their day-to-day finances as they are working on their new ability to purchase a property. All right, we've already spoken about the limited ability to work around the FHA limitation on multiple mortgages. All right. The basic way that this is more than just an enhancement to these borrowers is absolutely fantastic. Because in an absolute case of relocation, all right, the ability to say that you're increasing your family size as a result of the devastation. Let's say if you have, you know, a multi-generational home now as a result of the storm, being able to get out of needing to show a resolution to your existing mortgage or any mortgage from your co-applicants is going to be a huge, huge thing for these borrowers. Vacating a jointly owned property is also something that is normally never considered to be a good excuse or reason to get around the multiple mortgage obligation rule. So this is, really something that's kind of unprecedented inside of FHA to actually have a program that puts down in in writing that these light exceptions to that particular rule actually do exist. Also, in shifting gears and talking about people that want to rebuild, the enhancements to the 203K loan for 203H borrowers are something that are designed to absolutely put them back in the driver's seat so that they can begin to make decisions about just how and who they would like to have aiding them on the ability to rebuild their home. All right. So, and just getting, to talk about it, the ability to immediately know what kind of budget you can work with as opposed to just waiting to find out from the insurance company how much money they are chipping in, and then to look at your own personal withholdings to see how you are going to be able to contribute to to the rebuilding efforts. This is a very powerful way to know that you can leverage your home to help it save itself, and essentially end some of the waiting, because you'll be able to begin to make arrangements immediately so that you can immediately get the rebuilding process underway. All right. In many cases, there are going to be homes that are being rebuilt and renovated where the safety codes in terms of cast off away from your margin to be away from either water or away from the original property line may be affected, which can greatly add to the cost of making renovations to the home. In these particular cases, the 203H is going to allow for these borrowers to really not worry about being short on money, because those new changes to safety codes are not going to be something that will be assessed by the insurance company. So these are things that are definitely going to be of an advantage to a homeowner. Another consideration to make: if this borrower wants to rebuild the home beyond its original capability, so if they want to make improvements above and beyond what was there initially prior to the storm or prior to the devastation or catastrophic event, they will be able to make those changes. Right? Everything about our normal flexibility with the 203K program is still baked in, even though we're using it in conjunction with a 203H eligible borrower. And last but not least, certainly the ability to begin selecting a contractor so that borrowers may have the ability to secure good contractors that are in the area before they completely become out of reach, because people that did have the cash to secure their services have already lined them up with work. So with the all the areas around the Gulf Coast that are in definite need of these programs right now, this is a fantastic opportunity to allow these borrowers to be able to begin the recovery process on either track a little bit more succinctly than they are without it. Now, having said all of these things about the program, I know many of you are going to be wondering about the degree of difficulty that you will have trying to leverage this product effectively for borrowers. And let's face it, these borrowers are in far more stressful situations than normal. So we definitely want to do everything that we can to ensure that these borrowers are not going to be in for a tumultuous experience when it comes down to the qualification process or the submission, approval, and closing process of these loans. All right, so the 203H is definitely designed to be more flexible for these borrowers. All of our normal Rem and wholesale policies, that are absolutely designed to make sure that you, as loan officers, are able to provide your borrowers with smooth and expedient services for all their escrow needs are going to absolutely come into play. This is going to include things that are very much important to borrowers in these situations. Our same-day turn times, or at least at the absolute worst, being 24-hour turn times if you get your loans in, in the afternoons. If your borrower is looking at purchasing, the ability to do TBD underwriting, also going to be very huge. With TBD underwriting here at Rim and Wholesale, that literally means we will issue a commitment even if the borrower does not have a subject property address on the purchase, so that they'll be able to shop with the commitment in hand. That is that can be a huge advantage, especially if there's a rush on homes in the surrounding areas as borrowers are choosing to relocate. For anyone looking at doing refinancing, specifically speaking to the Gulf Coast state of Texas, your cash out rules are probably some of the most restrictive in the country. As a 203K loan in general, these loans are always done as not being cash out. So borrowers are going to have the ability to rebuild these homes and not be saddled in what will be forever considered to be a cash out mortgage or to be a cash out property. Aside from saying that, having a bank as the structured payor to the contractor also alleviates a ton of the stress of going through this process. Vetting the contractor, for instance, becomes something that is the lender's responsibility. We do that in all of our 203K loans. We are certainly going to do it with our combination 203H, 203K loans. The post-closing process by which we render inspections and make payments to the contractor, largely to avoid stress to the borrower, absolutely going to be of tantamount importance in these situations because, let's just face it, these homeowners, these borrowers have been through enough. So with that being said, we want to make sure that everything that goes into this process is done to lower the degree of difficulty for the borrower by making it simple and easy to know if your borrower qualifies for the program. Again, you can go to FEMA's website and you can look at all the presidentially declared disaster areas. As new presidentially declared disaster areas become, are declared, they will be, in the running to be considered as 203H eligible borrowers. The second half to the eligibility criteria to become, 203H eligible is being able to document the devastation to your home. And that devastation to your home needs to be to the degree that reconstruction or elimination was entirely necessary. All right, so with that being the simple eligibility criteria, again, we do not want borrowers to have to trudge up and dig through, new painful memories or to re-experience it all over again. Anything that they've already done to the degree of proving this is going to be acceptable. So when it comes down to it, again, just to reiterate, insurance reports, inspection reports from both government agencies and from qualified independent inspectors, appraisal reports, and or pictures taken to extensively document the degree of damage will be acceptable without forcing the borrower to go out and purchase new reports or new documentation of the devastation to the home. And that, in essence, is basically all of the information that we have to really share on the product, in general, as a blanket piece. I do understand that many of you are going to have questions about how this product is interwoven between the 203B and the 203K. So I have designed this to actually stand as a very, as an extended question and answer session, because I definitely understand that there will be extensive questions and I can see that they're pouring in. So let us begin that process now so that we are able to answer questions. All right, and as expected, one of the first questions that I see is just regarding, the availability of the PowerPoint to the attendees. And yes, we will make sure that this PowerPoint presentation is made available to everyone that was in attendance today. That is something that you will receive from my marketing department, because we have to we have to send it out in a very particular way because of all the restrictions on sending mass emails with attachments. So that is something that will come in the, definitely in the balance of this week. So let's see, our next question, Greg Wilcox, do they have to be experienced with direct loss or can they simply reside in the area? All right. Now, Greg's question is basically if the borrower resides in the presidentially declared disaster area, but their home was not directly affected, are they still going to be eligible? That borrower only meets one half of the eligibility criteria to specifically be a 203H borrower. So while that borrower certainly would be eligible as a 203K borrower in particular, as a 203K borrower or as, as a regular purchaser, certainly, but they don't meet both halves of the criteria to be a 203H borrower because they're not going to be able to show that their home was particularly affected. And you need to have both halves of that coin as opposed to one, Greg. So if that isn't clear, please let me know if you still need further clarification on that issue. All right, your next question also came from Greg, and it was about the exclusions. So hold on. This question is the exclusion of the existing debt tied to the borrower claiming total loss and electing not to rebuild? Well, Greg, this question is more of a positive answer. If the borrower chooses not to rebuild the home and wants to relocate, certainly the exclusion is going to apply to them because let's say even if their existing mortgage is an FHA product, then we certainly are not going to consider the single mortgage rule as a basis of not being able to do that new loan. Now, even if this borrower elects to, to rebuild, the credit benefits of the 203H is still going to help this borrower out because you have other consumer debts that can also have been impacted and could have suffering payment histories as a result of the disasters that the borrower has faced. So even for refinance borrowers and, the situation that they have with late, certainly they are going to be benefited by the 203H, both for mortgage payments and also with our ability to be a little bit more lenient in terms of determining other credit lates that have definitely been attributed, to the result of the actual disaster. All right, now an attendee named Ray has asked the question, how will we treat FICO scores since we don't have mortgage rates? Everything regarding normal qualification criteria in terms of credit is going to be in place. So in general, Rem and Wholesale, we are able to work with borrowers down to a 550 credit score. In our normal credit and underwriting guidelines for manual underwrites, anything under 620, they're all going to be, in place. So our normal credit tiers will be there. The difference with 203H borrowers, we will look at the mortgage rates, especially mortgage rates that have taken place after the disaster, as being something that we will not consider negatively against the borrower. Now, previous mortgage rates, if the borrower had a little bit of a messy payment history prior to the disaster, those will be considered. So this isn't a blank slate that allows borrowers with bad payment histories just to qualify. We are specifically talking about mortgage rates or credit rates that are directly tied to the results of the catastrophic event that caused the area to be declared a presidentially declared major disaster area. All right, so Ray, that doesn't answer your question. Please let me know and submit an additional question, and I will try to get you the clarification that you need. All right, now Greg's asked the question, can you stack insurance proceeds with the loan? And the answer to that question is absolutely. Going back even to the Superstorm Sandy provisions from a few years ago, one of the greatest joys is allowing borrowers the ability to apply flexibility with their insurance proceeds. Now, in some cases, the insurance proceeds will not make it back in time for the borrower's closing. So when that happens, unfortunately, it's beyond our control to make that money materialize exactly when we need it to. Certainly, if the borrower needs to input cash into the actual closing and the source of that money is going to be the insurance payout, we absolutely understand that, and we will do everything that we can to work with the borrower to arrange the closing so that it can coincide with the insurance money coming back in. So yes, we will allow them to stack the proceeds of the insurance with these loans so that they can either rebuild or purchase a new property if they so choose. All right, it looks like that was a combination question because I see another that says to exceed county loan limits. Greg, the maximum loan amount that we will be able to issue will be the county lending limit. So if the borrower needs any monies over that, certainly they will have to bring them to the table themselves. The insurance money is a great source of proceeds, for that particular reason. So hopefully, Greg, that is a complete answer to that question. Now, the next question comes from someone named Glenn, and this question is, I am assuming contractors need to be HUD approved just like normal 203K loan. Well, Glenn, the answer to your question actually is contractors are not ever approved by HUD. Contractors are approved by the issuing lender. So in this case, if you were bringing a 203H eligible loan through us, we would be the lender that is doing the contractor vetting and ultimately the contractor approval. So it doesn't need to be HUD approved. It's approved by the lender. In our particular case, contractor vetting is a 24 to 48-hour process, and any resulting conditions or questions that we have for the contractor will be issued on the borrower's loan approval. So hopefully, Glenn, that is a sufficient answer to your question. Let's see what our next question is, and it comes from Deborah. And that question is, will AUS systems recognize the late after disaster, or will this be a manual underwrite? Now, when you are actually pulling case numbers for your borrowers as 203H, as 203H eligible, these are going to be things that are not going to be necessarily flagged, particularly by the AUS. All right, so there will be a manual take to it, but this is one of our strengths here at Remnant Wholesale in particular. We have literally one of the greatest group of FHA government underwriters I've ever seen assembled in one particular place. So yes, it will take some manual dexterity to be able to factor through these things. Luckily for us, that happens to be one of our strengths. All right, but any place that you go to is, that is a good partner for your FHA business should definitely have the manual dexterity to apply this common sense factors to the loans, as manual files. But definitely there is a huge huge element of manual underwriting to be levied against, this particular problem. But that's not necessarily a detriment. It's actually a good thing. So Deborah, please let me know if that is not a sufficient answer to your question. Our next question comes from Enrique, and his question is, so the responsibility isn't on the LOs to secure the contractor and HUD consultant, but the contractor have to be approved by Remnant before the loan closes. And the simple answer to your question, Enrique, does the contractor have to be approved by Remnant? Yes, the contractor does. The documentation required to have a contractor approved needs to be submitted to Remnant at the time when you actually submit your mortgage application so that your borrower can know whether or not that contractor is acceptable at the beginning of the process as opposed to the very end. Please, let's all remember, these borrowers are going through a very stressful time. So we don't want them to have the impression of having last-minute curveballs or crazy changes in circumstances as they're finding out, seemingly the last minute, that they will not be able to use the contractor that they have found. So we want to get that information right up front so that this way we can give the borrowers answers right on time. Now, in order to secure a contractor, this isn't the loan officer's responsibility. It is ultimately the borrower's responsibility. You want the borrower to work with the contractor that makes them feel comfortable and secure, especially when they are dealing with situations like this one, because their entire lives are entirely far too upside down. So we want the borrowers to be comfortable and happy with the selection of a contractor. For the LO, this should not be your responsibility. This should definitely be something that the borrower works on. In terms of the actual consultant, again, this is going to be a borrower hire. You want this to be a consultant that the borrower feels comfortable with, because this is going to be the person providing them with all the inspections throughout the construction process. So you definitely want to have a situation where the borrower and the consultant see eye to eye and are comfortable with one another. So Enrique, if that wasn't a sufficient answer to the question, please let me know by submitting an additional question. Our next question came from Keith, and he wanted to know if I had the link for FEMA. And in some of our other materials, I actually do have that information. Just wanted to make sure that I can copy it directly because I didn't include it inside of the slide out of worry that the information could possibly change. But I do have that, at least I believe that I had that URL. Maybe one quick Google search would be able to reveal that for me. All right, and this is that website. And the beautiful thing about the website is that you will be able to just do a quick search to find areas as they are added to the site. And I saw that there was a question about the California wildfires. And if we take a look, they have been added as of October 8th, 2017. So the California wildfire areas will be eligible until October 8th of 2018 to have case numbers pulled. But this is as easy as it is that you can use the recent section in the middle part of this webpage to find the information, or you can actually do a search using the search criteria here at the top of this individual page. So Keith, please make note, if you go directly to FEMA.gov/disasters, you will be able to find this page. Now see, our next question. Our next question again comes from Enrique. And his question is, for people affected that lived in rentals, does the 100% financing apply to buy a new home so they can get out of that area? And Enrique, absolutely. These borrowers will be able to use 100% financing to relocate to a brand new area. Now, they can elect to buy a home within the disaster area, but they will also be able to buy a home that's outside of the disaster area. So this is absolutely fantastic for renters that are affected by these disasters. Our next question comes from Stephanie, and her question is, what if a borrower has an eviction letter from a landlord due to damage? Absolutely. That eviction due to damage and the inability of the landlord to repair the home in a sufficient time frame absolutely is going to be sufficient for this borrower because obviously, A, they were inside of the disaster area, and then B, the eviction letter is going to include the address and it's going to include the information that shows that the borrower was directly affected by both the A being in the presidentially declared major disaster area and also if there was damage to the home. And certainly their own ability to take pictures in conjunction with that letter should be enough for them to qualify. So Stephanie, please let me know if that is not a sufficient answer to your question. Our next question comes from Rakesh, and this question is, what about renters in the disaster area? Can they purchase and use the H program? And absolutely, Rakesh, they will be able to. The burden of criteria is going to be showing that A, they were a resident at the time of the disaster itself, and then B, damage to the home that they were renting that shows that it needed to either be reconstructed or demolished. Our next question comes from Ken, and it was a question regarding the PowerPoint, and the answer, yes, I will make sure that this PowerPoint is made available via my marketing department and the balance of this week. Tom has asked the question about how to find the disaster areas. And quite simply, it is this link, FEMA.gov/disasters. That will reveal to you the area that are definitely declared to be presidentially declared major disaster areas. Our next question was from Brian, and Brian has asked about specifically car payments that are now going to be late because of the, maybe due to the destruction of the car, or or the borrowers not having the ability to make the payments in some way connected to the disaster. Consumer rates are something that we are definitely going to be applying some of that manual muscle to be more lenient on, especially when we can show that the lates are directly attributed to the effects of the devastation. So definitely, those type of situations are certainly going to be far more easy to manage from either the purchase or refinance perspective. I'm sorry, purchase or refinance perspective. Due to the 203H, those borrowers are going to have a definite boost in credit qualification after facing additional hardships on their consumer credits on things like car loans specifically due to the storm. So the answer to your question, Brian, absolutely yes. Those borrowers will see a benefit in credit qualifying due to being 203H borrowers. Our next question comes from Levon, and Levon asks, what documents should renters provide to prove their primary residence was destroyed or severely damaged? And again, for these types of borrowers, being able to show, one of the first documents that comes to mind would be the initial lease or their lease agreement showing the actual address, a voter registration card showing that they are residing, at an address within the presidentially declared disaster area, utility bills going to that particular residence inside of the disaster area itself. Those are all things that they can use to document actually living inside of the disaster area at that particular residence. And then for the damage, pictures that they've taken, if they had renter's insurance and there was an insurance report actually created to compensate them for items that they had inside of the home that were damaged at that particular time, or even that potential borrower's own pictures of the residence illustrating the damage that shows that the property needed to be either reconstructed or demolished. So Levon, they'll be able to use any and all of those things. Please let me know if you still have questions regarding this particular issue, and I will certainly get you any corrections that I can. Our next question comes from Sue, and Sue has asked, what would they want to walk away from the damaged home and buy a new home in that area? Will they have to sell the damaged home first? So just to try to reiterate the question, Sue wants to know is, what Sue wants to know is, if the borrower's home is damaged to the point that they do not want to rebuild and they would prefer to actually vacate the home and relocate, will they have to sell the existing home first? And the answer is no. All right, they just have to be in process of actually trying to resolve in one way or another. So any efforts that they have to resolve that can be documented, but most importantly, having a home that's in the disaster area that they do not wish to rebuild, we will not consider the debt ratio or resulting credit rates from that particular home as we are working on the application for the borrower to relocate as a 203H eligible borrower. All right, so that is absolutely huge for borrowers that do not wish to rebuild their homes. If I'm not clear, Sue, or you need if you need any correction, please let me know so that I can get you that information. All right, now Patricia has a question, and she is asking, if a borrower is a renter and the rental was destroyed, can they purchase with the 203H? And the answer to that question, Patricia, quite simply is yes. Those borrowers that were renting inside of the presidentially declared disaster area and were affected by the separation of their home will be able to purchase a new home and relocate using the expanded 100% LTV. All right, and Brian has a question regarding ratios. Now, Brian, your question is in particular to a borrower that has elevated ratios due to a car payment. The car payment, that's not necessarily something that's going to be protected by the borrower being a 203H. Specifically, mortgage payments or housing payments, yes, but car payments, not particularly. The borrower certainly won't be held for the relates to the car, but the actual payment itself is still something that is going to be, something that they're going to have to remedy on their own steam. All right, I can't absolutely guarantee that a burnt out car in the storm is something that we will entirely ignore, but it is something that we will be as lenient as possible in trying to understand the real world implications of everything that happened, including what happened with the car. But certainly, I can't say carte blanche that that's going to be completely ignored in terms of ratios. So hopefully, Brian, that answer clears up your question in regards to the car. Our next question comes from Ken, and Ken has asked, a borrower lives in an apartment and had to move out due to damage to the property. Will they qualify for this program? As long as the borrower meets both sides of the eligibility criteria to be 203H eligible, and that is, as long as that property was in the presidentially declared major disaster area and that home sustained sufficient damage that would cause or necessitate the reconstruction of the property or the complete and total elimination of the property. So as long as both of those things happen to be true, then absolutely that borrower would be able to make use of the 203H program even if he was only renting the property that was directly affected. All right, our next question comes from Candace, and Candace has asked, a renter in the affected area who decides to purchase inside or outside the affected area could get a 203H with 100% LTV without taking late rent payments or utilities, question mark, after the date of the disaster into account if shown on the credit report, correct? So Candace, to answer your question, yes, if the borrower's recent issues with being able to make timely rental or utility payments are tied to the storm, absolutely, we will not consider those things against the borrower's direct credit. So what we are trying to do with this program is to allow ourselves to use the extra leniency being given by HUD to help these borrowers reconstruct their lives in as efficient and expedient of a manner as humanly possible. So yes, Candace, things specifically like late rental payments and or resulting utility, issues with making the utility payments as they are trying to establish temporary housing, we are certainly going to be understanding of those things, and we will literally use every degree of latitude given to us by HUD to help these borrowers qualify with those particular issues. So please, Candace, let me know if there is any lingering question regarding that particular issue. Now, Roman Washington has a question, and Roman, sorry for using your last name there, but Roman asked, do investment properties qualify for the 203H loan? And unfortunately, they do not. All HUD programs are going to be specifically geared toward helping owner occupants. So if a borrower is, had an investment property, unfortunately, they are not going to necessarily qualify because their residence is not that particular property. Now, the people that were renting the property, they will because they were directly affected by that property's destruction. But as a owner of an investment, unfortunately, this expanded protection is not going to be necessarily directed in investors' direction. Okay, our next question comes from Levon, and her question is, the program available to borrower who are temporarily displaced? For instance, they lived on the first floor of an apartment complex that was flooded and the borrower was required to vacate the property, and the property management cannot give them a specific date that their apartment will be habitable once again. And yes, that particular borrower located inside of the presidentially declared major disaster area and was forced to separate from the property due to flooding. So absolutely, their particular unit was needed to be reconstructed as a result. So since they were separated, they absolutely will be able to use a 203H to purchase a new home with 100% financing. So yes, Levon, that particular borrower would be able to qualify as a 203H. All right, our next question comes from Veronica, and she's asked, does using this program to purchase a new home, one already has an FHA mortgage, does purchasing another home within 100 miles still exist? Now, the 100-mile rule, this is part of the single FHA loan rule, and this is going to be something that's within our exclusion. So if the borrower is relocating, they do not have to relocate outside of 100 miles of their current FHA mortgage. All right, so let's not worry about that at all. If they wanted to move to a home that is literally only 2 miles away and that's where they choose to relocate, they will be perfectly free to choose to do so because this is a relocation 203H loan. So please, Veronica, if you are still unsure, let me know by asking a follow-up question, and I will gladly give you any clarification that I can. See, our next question comes from Michael, and this question is this product for people who aren't able to be indemnified by their homeowners insurance companies? Many borrowers that are going to receive either no insurance or very much underwhelming monies from the insurance company, you know, after facing the devastation, certainly they will want to make use of a program like this one, because otherwise they will be stuck trying to, either repurchase or to rebuild using their own funds. And yes, borrowers that are in that situation absolutely will be able to leverage these programs. They just unfortunately will not have the additional aid of significant or any money at all coming back to them from their insurance companies. So they will find this as a much needed source of refuge from the elements. So Michael, hopefully that is the answer you needed. Our next question comes from Cody. Will this be manually underwritten loan? How can we get the approval eligible with mortgage rates? The mortgage rates may prove to be problematic in getting through an automated underwriting system. All right. So with that being said, we will look at these files as manual underwrites, and certainly we'll be able to apply the protections given by the 203H to 203H eligible borrowers. So Cody, don't let underwriting, don't let an automated underwriting system be the end of it. Yes, you do want to actually submit those loans as manual underwrites whenever the loan is certainly being affected from a credit standpoint by the devastation for a 203H eligible borrower. Our next question comes from Michael. Renters essentially get an opportunity to purchase a property in the disaster zone or in another location, and the answer is yes. They can choose to live either inside of the presidentially declared disaster area, or they can choose to find a residence outside of the presidentially declared disaster area with 100% financing. Our next question comes from Glenn, and that wasn't an actual question, but he said, awesome and thank you. I'm glad I was able to answer your question, Glenn. All right, our next question comes from Jeffrey, and this question is, what if the insurance is slow with paying a client and they need funds to get closed? The borrower will be able to elect to use gift funds as they normally would, but unfortunately, if a significant part of the money is coming from the insurance, there's nothing that we can do to expedite, the insurance company with giving the borrower funds. So unfortunately, that's not something that we can do for the borrower. We would have to wait for the funds to come in from the insurance company, or we would have to take a look at the possibility of the borrower using gift funds from a direct relative. But unfortunately, those are the options that we have. We are not under the ability to just fund the difference in money. We can only give the eligible amount underneath the 203K or the 203B program for the borrowers, and any additional funds that they need to bring into closing, they have to bring in from an eligible source. So Jeffrey, please let me know if you have any additional or follow-up questions on that topic. Our next question again comes from Veronica, and Veronica has asked, will this program work if mold has developed in the walls due to high flooding for several days? Absolutely, Veronica. The 203K program has been used for mold remediation from the beginning of the 203K program. So definitely any and all recovery options that have to be done, reconstruction options that have to be performed on a home can absolutely be undertaken with the 203K, especially considering, these borrowers are now subject to these additional protections because of the devastation that allowed them to become 203H eligible. Our next question comes from Brian. Will living expenses while out of the house be rolled into the new loan like a 203K? Yes, the borrower, when they're electing to do the refinance, will be able to finance the mortgage payments if, under the same normal criteria under the 203K program. So it's still going to be the same for rolling in new mortgage payments on the 203K loan. So it will still be exactly the same. There has to be a consultant involved. The consultant will have to say that the property is uninhabitable throughout the course of the renovation, and if the borrowers then elect to do a payment reserve, they certainly will be able to do so All right, Brian, so please let me know if that remains to be unclear. Otherwise, we will move to the next question. And this question is from Tom. And he says, are the presidential disasters noted as major disasters? And the answer is yes. It must be noted as a major disaster area. All right, so a presidentially declared major disaster area, Tom, that is the full wording. And I'm sorry if at any point I neglected to use the word major. I do apologize about that if I did, which I believe that I might have done a few times. But yes, it has to be a presidentially declared major disaster area. All right, so let's see. Our next question. So the next question is basically regarding our ability to overlook an existing lien, and this is something that is being allowed to be done by HUD. So HUD is giving us the deference to look past an existing lien obligation for a borrower if they are opting to relocate. Now, if the borrower has an existing lien on a property and it's a 203K, we are paying off that lien. It's a 203K. It's a refinance program. So in that particular case, it's a moot point. But when a borrower is relocating, part of the process is going to be showing that they are in some type of arrangement or working on an arrangement to have the initial lien satisfied, which is something that is going to happen at the servicing level for the existing lien. But as a lender working on a new lien, we are just looking for documentation of that process, but not necessarily, we don't have to actually wait for the conclusion of said process, because some of these loans will take a long time to fully remediate. All right, Jerry, so please, if you have additional questions regarding that, let me know, but it sounds like your questions are looking for a finite answer as to when and how these things will be remediated, which I won't be able to give you. Let's see, our next question comes from Jerry, and this question is, does an existing residence need to be uninhabitable to be considered by a lender or borrower to have the borrower become eligible for the 203H? And the property needs to either need to show that it needs to be reconstructed, so that's any major renovation, or if it's even beyond reconstruction, if it then needs to be demolished, then the borrower would also be able to be eligible. But it's not just for cases where the property needs to be demolished. Any major reconstruction is also going to be enough for the borrower to show that second leg of eligibility for the 203H program. All right, that is Jerry's question. Let's see. Jerry's next. Jerry has another question. All right, we've only had the 203H, Jerry, on our books for just the last couple of weeks, and we certainly understand. And Jerry's question, I'm sorry, since I didn't actually restate it. Jerry's question is, in our experience, how long or how quickly have servicers responded to borrowers and showing and documenting the efforts to satisfy the existing lien if they want to relocate? And the answer to that question is, not determined just yet. It is going to be a very long process for some borrowers to show documentation, and for some it's going to be relatively quick. So there's no rule of thumb. We are definitely needing to actually flex underwriting muscle and being able to roll with the punches and help borrowers as they are trying to procure documentation. So there's no hard and fast rule that I can give you. Some servicers are going to be very quick, some servicers are going to be exceedingly long, and we are going to do our best to work with the borrowers on documenting the information as they are able to provide it to us. And Jerry, to say sufficient damage is going to be damage that constitutes either reconstruction or demolition. So is going to go by the actual damage that occurred to the home. So there's not going to be a hard and fast way to show it. If a property only needs to have flooring replaced, that's not going to be major reconstruction. So it's going to go on a case-by-case basis. We're literally going to have to take a look at the actual damage sustained to the borrower's car and residence to be able to answer that question, or to at least give me a for instance. But there's no way for me to give you, simply put in one sentence, the definition of sufficient damage. right, Deborah is noting that my answer regarding the car lates and and the previous statements regarding being able to be more lenient with borrowers with late on consumer issues post disaster are contradictory. If you go back and actually listen to the answer, I did not say the late would not, I did not say the issue was the late. I said from the perspective of debt ratio, we cannot forget that the borrower still is obligated to make consumer payments. So the consumer payments are not subject to the automatic forgiveness in terms of excluding them from debt ratio. The idea that the payments are late in general, we will be lenient on that and we will be able to overlook late payments stemming from the disaster. However, the only payments subjected to the exclusion from debt ratio are those on a mortgage. All right, Deborah, so please let me know if you are not clear on that particular issue. All right, let's see. Our next question is in regards to the 4000.1. And Lara, I will definitely research that and give you the exact location on the 203H where you can find the information regarding the exclusions for the 203H. But at this time, I'm obviously not equipped to go searching through the 4000.1 at exactly this time, but I will send you that information via email. Let's see, our next question is going to come from Deborah, and it's regarding insurance funds. All right, and essentially she wants to know how will insurance funds be factored in. Insurance funds are going to be monies basically paid by the borrower, and the insurance is going to be the source of funds. So that is quite simply how this is, going to work. It's not going to be something that we consider part of the financing. It is going to be borrower included funds, and the source of those funds is going to be the insurance payout. It is literally that simple, Deborah. Please let me know if you need a more substantial answer to that particular question. Our next question comes from Patricia. Can a borrower purchase a home that was damaged by the hurricane and use the 203H enhancement? Again, this is the first time this question has been particularly asked. That's going to be a little bit trickier implementation of the 203H because the 203H, the home itself being damaged by the 203H is not enough for the borrower to become a 203H borrower. The borrower in particular has to be 203H eligible. If a 203H eligible borrower wants to purchase another home that was actually impacted by the disaster, it's not necessarily something I can say absolutely yes to, because the 203H purchases are designed to be 203B purchases. So I'm going to have to do a little bit more research to find an actual clear answer for you on that. But that is actually a great question, and it's not one that I have a succinct answer for at this time. But I will definitely look into finding an answer for you, Patricia. Let's see, our next question. I'm trying to make sure, I'm reading back and forth to make sure I have your question correct, Lara. I have spoken so much to this point. I'm trying to remember specifically what your initial question was. All right, Lara, on the exclusion topic, there is specific language about the exclusion from normally being not allowed to have multiple FHA mortgages. All right, there is language there that is for that, and I will specifically find it and track it down for you. But I don't want to rehash this topic again and again during the same Q&A session, because I'm sure other people have their own questions that they definitely need to have answers. Let's see, the next question is from Brian, and his question is, does insurance contribution count towards 97.75% LTV? What he means to say for refinances, not sure how it would work. Brian, money from the insurance company is going to be the borrower's contribution at the table. So no, it is not going to be considered part of the 97.75%. If after the 97.75% LTV is applied, if the borrower still needs funds to close because it's not enough money to pay for all of the actual construction happening to the property, the borrower would then be able to contribute the remaining money required. And that money, the source of funds, can be the borrower's insurance payout. But it's that simple. The actual 97.75% LTV is simply a factor of the borrower, of the cost of construction for the renovations that have to occur to the property and the payoff on the existing property. We're actually going to take 97.75% of the after improved value denoted on the appraisal. So whatever the actual property's post-improvement value is going to be, we're going to factor 97.75% of that, and that will be the borrower's loan amount. If that loan amount is not sufficient to pay off both the existing debt and establish the repair escrow needed to make the renovations, then the borrower can contribute their own funds. The source of funds for the borrower's contribution can certainly be the insurance payout. So hopefully, Brian, that answers your question regarding the insurance. All right, and Veronica, I will certainly also send you the information regarding a 203H borrower being able to purchase a damaged home and perform a 203K. I'm going to look into that one because I don't have a succinct answer, but I will certainly get back to you with the information regarding that particular topic, which is an interesting topic, for certain. And it looks like, 40 minutes after going through all of the questions, one more, and Brian's last question, it looks like, is how to become approved with Remen. Brian, the only thing you really need to do is send me an email, and I will certainly have one of our, literally the most local that we can find account executive reach out to you, and they can walk you through the sign-up process to become approved with Remen. We will absolutely do everything that we can to get you onboarded quickly. And you'll note most of our process is actually handled online now. It's not all physical paper anymore. So we try to be as lenient with it as possible. Certainly, as you're going through the approval process, your AE or your new AE will be able to get you, log into system credentials so that you can begin to submit loans. And even during the process of becoming set up, you won't be able to get the loans funded, but you will be able to submit them and work them through the approval process and get them up to the point where they could be cleared to close. It's just that we wouldn't be able to close and fund your loan until you are fully approved with Remen at that particular time. Oh, wait, and answering Brian's question, we have one more question from Jacqueline here, and it says, if we are a licensed mortgage loan officer in Florida and due to disaster, a borrower wants to relocate, for instance, to Atlanta, how would that work if we are licensed to do mortgages in Florida but not in Atlanta? So your options for that particular borrower, since you are not able to actually get that loan funded, there are certainly going to be some options if you have a good AE to try to find another another loan officer that is sufficiently licensed to close loans in the state of Georgia, so that they would be able to move the loan. And then you'd have to do it together. But to be honest with you, that is something of more of a normal problem that we've always faced. There certainly are creative ways to work with it, and certainly if you could find a loan officer that is sufficiently licensed in that state, you would still be able to help that borrower with their relocation to Atlanta. So Jacqueline, if you have any other questions regarding that, please let me know, and you can certainly reach out to me via email. Anybody that had a question that was a little bit too particular or was something that you think of afterwards, you will be able to reach out to me. My email address is drichardson, just spelled just the way it sounds, D, then RICHARDSON. That's drichardson at remen.com. That is my direct email address. Please, if you have questions regarding the 203H, reach out to me, and I will certainly do my best to get you answers as quickly as humanly possible. Thank you to everyone that sat through not only the session, but this extended Q&A session that we've held afterwards. I certainly appreciate the ability to be able to answer questions about this, very topical, but certainly, you know, um, much needed program in regards to, all of the recent disasters that the homeowners have been facing across areas of the country. This is a program that I feel will definitely be on the books for some time to come, as we are doing as a community, and as really essentially what is a service to homeowners, everything that we can do to help these borrowers recover and be able to move forward in their lives. I thank you for all of your efforts in helping them to do so, and anything that we can do as a company to certainly help you in terms of information and being able to be a platinum partner to help you leverage these products effectively in your own efforts to help these homeowners. I applaud you on your work to do so, and certainly we pledge to do everything that we can to help you. Thank you again, everyone. I look forward to working with you all in the future.